All right, hello, welcome back into the NetPicks Inner Circle. In this video, I'm going to highlight our Options Express trades here from this past week. It was a very active week for us. We closed out of 6 existing positions and opened up 3 new trades here earlier in today's session. So we'll walk through each one of those trades in just a moment. Before we do so, I want to talk about the market big picture going into next week. We saw some significant selling pressure here just the last 2 days to end the week. We closed right down near the lows of not only Friday's session, but also near the lows of the week here today. So there's definitely some fear coming back into this market. We closed right on top of the 200 period moving averages on the daily chart of SPY, both the simple and the exponential moving averages. The last time we tested these levels was back during the initial wave to the downside back in early February. Well, you can see back in February, those levels held, and over the next number of weeks, we saw a pretty significant rally off of those lows. The question becomes, is that pattern going to repeat itself going into next week? Obviously, time will tell. We don't know yet. But here's some clues that I'll be watching for next week. First of all, Monday morning, if we get a lower open, there could be one more wave to the downside yet. The reason I point that out, we have not tested below the 200 period moving averages for months and months. If we get a candle to move below that level, especially on a closing basis on Monday, if we get a daily candle to close below those levels, there could be a number of stops that are sitting right there. The market might decide to run those stops and give us one more push to the downside. So we'll want to watch that closely on Monday morning. But on the flip side, let's say that those levels hold. Let's say this market decides to bounce higher. For those of you that have been around for years, you know during those downtrending markets, I'm not going to call this a bear market yet, but when you start to get a nasty trend to the downside, that's typically when you see some vicious V-shaped rallies to the upside. Everybody starts to get short on the downside. Well, once you start to test a support level, it's very possible to see those short covering rallies to the upside, and they can happen very, very quickly. I think we're getting close to seeing one of those here going into next week. We are very oversold not only on SPY, but on many of the individual stocks on our list. You take a look at Facebook, down 14% here this week. You take a look at Netflix, Amazon, Apple, just to name some of the few or some of the big tech names that have led the charge to the upside. They all got beat up this past week. So in the near term, I could very well see a relief rally going into next week. I'm not saying the bottom is in. I could certainly see us heading lower over the next coming months, but in the very near term, over the next week or two, I definitely want to be prepared for that push to the upside. The reason I point that out is we start to take a look at some of the newer trades that we initiated today. You'll notice that I positioned ourselves neutral to slightly bullish going into the next 2 weeks. Now, we didn't get super aggressive. We only initiated 3 new trades, but I want to make sure we have some exposure there just in case we get some news over the weekend, the market decides to make a big move to the upside. I want to have some exposure there. It's been a very, very profitable week for us. We close out of a lot of trades. I do not have many positions open going into next week, so I wanted to get some new trades on this week, and I'll walk you through my line of thinking there when we take a look at the 3 trades in just a moment. So going into next week, Monday and Tuesday are going to be crucial. I think that's going to be the tell for the rest of the week. If we can get any type of a push to the upside, it could be a pretty significant rally. Our first area of resistance, the first moving averages that we have here, are all the way up around 267.80 to 268. There's a lot of open space in there for things to rally. The support levels, obviously we're sitting right on top of one at 258. Down below that level, we do have a swing from that February move to the downside, right around the 253 level. So that last push, if we break it, those support levels on Monday and Tuesday, we could see one more move down to that swing low. So those are some things that I'll be watching going into next week. The volume, I've been talking about this in our training room here the last couple of weeks. I have been expecting this move to the downside, but I wanted confirmation from volume. We got that in a big way the last 2 days. The key level for me on the volume side, I want to see 100 million shares traded on SPY. We blew through that level the last 2 days. In fact, we closed the week 175 million shares traded on Friday on SPY. That's a significant number. That means there's a lot of conviction behind the move. That makes it a lot easier for us to trade because there's a lot of volume there. It makes it easier for us to get quick fills and at good prices. So I'm hoping that we can start to settle in around that 100 million share range over the next couple of months. We'll see if that plays out or not. So neutral to slightly bullish going into early next week. And then if we do get that bounce, we'll reevaluate things and see, are we ready to roll back over to the downside again, or are we going to get some sustained buying pressure? We'll talk about that here more next week. Let me bring up the spreadsheet and let's talk initially about our trades that were closed out here this week. I have pulled up the spreadsheet. This is part of the spreadsheet that we show on the owner site. I resized it here just so we can focus in on the trades from this past week. I don't want to get us distracted by all the other information there. So I just focused in on these 6 trades. These were all trades that were opened up over the past couple of weeks, and they were all bearish positions. They were all short call spreads on a variety of different products, a mix of stocks and ETFs. But on that move to the upside that we just took a look at, after the February move to the downside, we started to get that rally, and it was impressive. So once we saw that rally get a little extended on the upside, I started to position ourselves bearish. And we did that by selling the call spreads. And we did so because I didn't know the timing of the move to the downside. If I buy a long put, I have to have the market move lower immediately. Otherwise, I'm going to be in trouble. The time decay is going to hurt me. By selling the call spread, it's a way for me to get into these trades a little bit sooner. Right? I don't have the pressure of it needing to be perfectly right on the timing of the trade, because when I sell a spread like this, the time decay is working in my favor. So by selling the call spreads, it's a way for me to lean bearish, but I'm able to do so in a little bit more conservative route. Okay, so let's talk about Amazon here first. You don't even need to take a look at a chart of Amazon. If you've been tracking the markets at all here over the past year or so, you know that Amazon has been on an absolute tear to the upside. And we started to see just a parabolic move to the upside over the past couple of months. So I started to sell call spreads on this thing, and we ended up selling the 1640, 1650 call spread. So I'm selling the 1640 call, I'm buying the 1650 call at the same time to make it a risk-defined trade. I get it. Amazon can be very expensive to trade. You buy a call or a put on Amazon, you're talking about thousands of dollars per contract. Well, on this guy here, it was a $10 wide spread. We collected $3.42 or $342 per spread to put the trade on. So this thing tied up $658 of capital. So you start to take a look at this. It's an expensive stock that a lot of people shy away from because it is so pricey. But when you utilize these spreads, we're able to reduce that cost significantly. So a pretty reasonable trade all in all. The $342 that we collected to put the trade on, that's our maximum profit potential. The only way we get to keep that is if we hold right up to expiration. This spread was sold in the March 29th weekly option. So we still had 1 week left. We could have held a week longer on this thing. I decided to close this trade out on Thursday. We started to get the market to show some signs of bouncing here yesterday. At that point, we already had a really nice profit on Amazon. I wanted to close this trade out because I didn't want to get caught by those V-shaped rallies that we've had so often over the past couple of months. So I wanted to take the profit while I could, free up the capital for a new round of trades. So we bought this thing back for 92 cents yesterday. It gave us a $250 profit per spread. Okay, $250 in and out in less than a couple of weeks. I mean, that's ideal for us. Now, we could have held on. I mean, we closed this trade out yesterday. Amazon got beat up again today. I mean, Amazon was down another, $50 here today. So had we held on to this trade into today, we could have had even a bigger profit yet. But when you can book that type of a profit, $250 profit, free up that capital for the next round of trades, I think that's a very wise decision. We typically target between 50 and 75% of our maximum profit potential on these trades. So we definitely had that by closing out of the trade yesterday. So really nice profit there. GILD was another one that we initiated here last week. We went out into the April 6th options. We sold the 81.82 call spread. So we sold the 81 call, bought the 82 call, collected 31 cents. The great part about this trade is we're talking about $69 of capital to put this trade on. So very reasonable regardless of your account size. You can put this thing on 10 times and you still have well under $1,000 of risk. So very manageable for those smaller account sizes. The $31 is the most we can make on the trade. Now, the issue here with GILD, We had the opportunity yesterday to close this thing out for 6 cents. So I bought it back for 6 pennies. Okay, 6 cents, it gave me a $25 profit per spread. Why did I do that? The market was falling apart. We had the directional move that we were looking for. Why not just hold the trade and hopefully let the whole thing expire worthless? Well, when I looked at it yesterday, we already had just about all of the profit potential out of this trade. There was only 6 cents left, or $6 per spread. Do I really want to hold for another couple of weeks for that last $6? Well, for me, in my mind, I'd rather pay the commission, close out of the trade, and free up the capital for the next new position. I don't really want to tie up all that capital for the next 2 weeks trying to get an extra $6. That's just not a wise use of our capital there. So we did close out of the position and we book the profit there. Again, $25 of profit per spread. And now you look at that and you're saying, well, $25, that's nothing. Keep in mind, we only tied up $69 of capital to begin with. Okay, so you put this thing on 10 times, you've got just under $700 of capital in play, and now you're talking about a $250 profit. All of a sudden, that's a little bit more attractive, right? Because on these short call spreads, I don't need a big directional move lower. If it moves up, down, or sideways, I make money as long as price action stays below our short call strike. So in this case on GLD, it just needed to close below 81. We made money. We made money from time decay adding up and from volatility decreasing. So we had 5 different ways of making money on these trades. That's why I love them so much. I think it's a great complement to some of our other strategies like the long calls and long puts. So really nice profit there on GILD. Similar story on Square, on symbol SQ. We came in and we sold the 56-57 call spread, collected 30 cents or $30 per spread. It tied up $70 of capital for every spread that we sold. Very similar to what we just talked about on GILD. We had some time left to expiration. I could have held into next week, but I was able to close this thing out for 8 cents. It gave me a $22 profit per spread. And again, my line of thinking here is I don't want to tie up all that capital for another week just for an additional $8 of profit potential. I'd rather pay the commission, close out of the trade, book the profit, and free up that capital for the next round of trades. Not to mention, what if we do get that very bullish reversal next week? I don't want these trades to go from a really nice profit to a loss. So we booked the partial profits there on GILD, SQ, and Amazon. The next 3 trades all expired worthless. Okay, so on the next 3 were actually options expiring today. So on QQQ, we sold the 174-175 call spread. Okay, so we did that back earlier in March. We collected 35 cents or $35 per spread. So $65 of capital is what it costs to sell each spread one time. Very reasonable cost here, and we let the whole thing expire worthless here this afternoon. So not only did we book the full profit, we didn't have to pay the commission to close out of the trade, and we kept the full $35 profit there per spread. Facebook, we sold the 187.5, 190 call spread. We collected 82 cents on this trade. So again, less than a couple $100 of capital in play here, and we're controlling 100 shares of Facebook. We let this thing expire worthless today. That gave me another $82 of profit. Didn't have to pay the commission to close out of the trade. So the reason I held these trades to expiration is because we saw price action move in our favor in a big way. These were all bearish trades. We got that bearish move. All we had to have happen is price action stay below our short strike, and it did so in a big way. So we were able to hold these trades right up to expiration here and book the full profit. Finally, on Netflix, we sold a 337.5, 340 call spread, collected 82 cents. This one also expired worthless. We initiated many of these trades back earlier in March. So did I know the market was going to move to the downside in a big way the last couple days? No. I positioned ourselves because we were overbought here a couple weeks ago. I was expecting a period of consolidation or a pullback. I just didn't know what was going to happen to this extent. But all these trades worked out well. Notice some of these names, I mean, Facebook, Netflix, QQQ. I mean, these are some of the names that got beat up the most here this week. So we were able to profit from that. So again, Netflix expired worthless today, gave us another $82 of profit. So without any type of money management built in here, that gave us $248 of profit if you're just taking every one of these trades with one spread. It's not the best way to do it. You know, it's the only fair way I know of tracking the trades here in the owner site on the spreadsheet. But when you take a look at it, trading one spread on Amazon is not equal to trading one spread on Square, right? I mean, you have to start to take advantage of the money management rules and say, okay, let's risk $500 per spread or $1,000 per trade. That could have you trading one or two spreads on a big product like Amazon. It could have you trading 5, 6, 7, 8 spreads on some of the smaller priced products. You want to do it like that so that the outcome of that one individual trade on Amazon does not completely dominate your P&L. I think we would all agree, if we have a losing trade on Amazon, it's going to wipe out a whole series of winners on some of the smaller price products if all we're doing is taking one spread on every trade. So when you're taking a look at these numbers, $248 of profit does not reflect any type of money management. If you have done any type of money management last week, let's just say you're risking $1,000 per trade, we're talking about a very significant profit number. Okay, but again, just for our example purposes here, I'm just reflecting taking every one of these trades with one spread. Now let's move on over. Let's take a look at some of our new trades that we initiated today. I tiptoed into some of these trades here because the market was definitely getting beat up. But I initiated a couple of short put spreads on QQQ and Tesla. Probably jumped the gun a little bit on these, but I wanted to get some exposure, some bullish exposure going into next week. So you can see the details of the trades here. I'm actually going to move the spreadsheet on over to my other monitor. That way we can spend some time over on the trade page walking through these trades. So I'll drag that spreadsheet over. Let's go over to the trade page and let's start out by taking a look at Tesla. I went out to the April 6th option. So we've got 14 days left. I went out a couple weeks just in case we're a little early here, just in case it takes a couple more days before we get that bounce that we're expecting. I wanted to have some additional time. So I went out 14 days. I came in and I sold the 295, 292.5 put spread. Tesla's definitely gotten beat up along with the rest of the market. So I want to position ourselves slightly bullish here. So I sold the 295 put and I bought the 292.5 put to make it a risk-defined trade. Okay, we collected 72 cents to put this trade on. You can now see that it's trading at 82 cents. You could have gotten filled at a better price point this afternoon had you gotten in after me. We initiated this alert. We sent out the text message. We sent it out through email, and we sent it to our Slack group to all of our students saying, okay, here's the trade. Here's our strike prices. Here's the price that we're looking to get filled at. So if you saw that alert late, you would have been able to get filled at a better price point than us. So I got filled at 72 cents. Let me go ahead and adjust this price a second. All right, so we're risking $178 to make 72. That's very typical for us. We're normally risking 2 or 3 to make 1. The reason we're willing to accept that is we have 5 different ways of making money on this trade. If it moves up, down, or sideways, as long as it stays above our break-even point at 294.28. So we've got about $7 that this thing could continue to move to the downside before we're in trouble. We also make money from time decay adding up and from volatility decreasing. The reason I like this trade, if I shrink this down a second, you'll notice that the IV percentile is pinned at 100. The volatility is at 52-week highs. I'm fully expecting over the next couple weeks for that volatility to contract a bit. It's not sustainable to stay up at these highs for volatility. So if I sell a put spread like we did, it gives me the benefit of profiting from that volatility contracting. So if that happens over the next week or two, that's going to allow us to make money faster. We're not going to need as big of a bounce to the upside because that volatility is going to help us. So really nice trade there. I really like the positioning of that trade. Again, our break-even point's at 294.28, and we're tying up around $178 of capital per spread. So pretty reasonable given how expensive Tesla stock is. So that was the first trade that we put on. The second one was on QQQ. Similar approach. We used the April 6th options, the weekly options with 14 days left. Okay, this one also, if we take a look down at the bottom, we have an IV percentile at 69. So not quite as high as Tesla, but it's still above that minimum 50 number that we like to see. Anything above the 50th percentile indicates to me that the prices of the options are more expensive. When that happens, it means that we can structure a trade with the odds working in our favor in a more significant route. So we'll take a look here at those April 6th options. I came in and I sold the 161.5, 160.5 put spread. So we did position ourselves bullish. We got into this trade a little bit early because the market definitely fell apart this afternoon in a pretty significant way. So when I put this trade on earlier Friday afternoon, again, we sold the 161.5 put. We bought the 160.5 put. We collected 34 cents to put this trade on. Okay, so let me adjust this here. You can see now it's trading for 53 cents, so you can definitely get filled at a better price on this one. So we put this trade on, collected 34 cents. It gave us $34 of profit potential, $66 of risk. So we're right around risk 2 to make 1. Very reasonable trade here. I mean, when I said I tiptoed into the trade earlier, I just wanted to get a starter position on. I may end up adding to this trade next week. I want to have some exposure just in case we get a big gap to the upside here Monday morning. So our break-even point's at 161.16. You can see now, I mean, I need, over the next 14 days, need about a $2.50 move to the upside on QQQ. So we've got our work cut out for us at this point, but I still like the positioning of this trade. We may end up adding a new short put spread next week with some different strike prices. I do think there's an opportunity there to play a bounce higher, so we'll see if that plays out or not. The third trade that we initiated was on Twitter, and we took a slightly different route here. Instead of just selling a put spread, we actually came in and we sold an iron condor. So I saw that the IV percentile was elevated. It's above 50. It's at the 53rd percentile, which is a good number for us. And we came in and I decided to use the April 20 monthly option. So we have a full 28 days left before expiration. With an iron condor, I like to go a little bit farther out in time because I want to let that time decay continue to add up for us. So an iron condor is simply selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. What that does essentially is it creates a profit window for us. Instead of expecting a big move higher or lower, I'm creating a window that I expect Twitter to stay inside of. And if it does, I get to make money from a sideways consolidation move. I think there's some opportunity in here if the market decides to get a little choppy, especially on some of these names that have been very active like Twitter. I think there's an opportunity in here to generate some income from a sideways move. So I came in and sold, make sure I get these strike prices right, the 33.5, 34.5 call spread. So let me right click on the 33.5 call, go to sell and go to iron condor. So it's the 33.5, 34.5 call spread. Then I also came in and I sold the 29.28 put spread. And we collected 52 cents to put this trade on. It's now trading for 53 cents. So by going out 28 days, it just gives us a slower reacting trade, which is kind of nice, especially in a market that's all over the place here. So we collected 52 cents or $52 per spread. We're risking 48 cents. So we're right around a risk 1 to make 1 type of scenario here. My break-even points are at 28.48 and 34.02. You can see them right here. As long as price action stays right inside of those numbers, I make money. So I don't need a big move higher or lower. All I need to do is come in and see, is Twitter inside of those 2 break-even points? If it is, I'm good to go. I'll make money from any type of directional move that we have inside of that range. I'll make money from time decay adding up and from volatility decreasing. So really like the positioning of this trade. It's just more of a neutral trade. I like to mix up my strategies because ultimately none of us know what the market's going to do next. So if Twitter kind of bounces around in here over the next couple weeks, we're positioned well for that move. So again, we closed out of 6 existing positions here this week. All of them were winners. So a lot of profit booked there. And then we initiated 3 open trades. And again, those are on Twitter, Tesla, and QQQ. If you are an Inner Circle member, you have access to all of those details on the owner's website. If you have any questions on those, feel free to send us an email. My email directly is mike@netpicks.com. We'll certainly keep you posted next week as well. Anytime it's time to close out of a position or make an adjustment to a trade, we'll certainly get those trade alerts out. That's the nice part about being part of the Options Express program. We do all the hard lifting for you, all the research work on our end. So all in all, very productive week, very, very profitable. I'm excited about next week. I think the market activity is here to stay, and that's a good thing, both with volatility and volume and ranges in the market. Everything's lining up for us here for a really active spring, so we'll see if that plays out or not. All right, so I'm going to start to wrap up this video here. We will be in our training room here on Tuesday of next week at 12 o'clock Eastern. That'll be our next live session. Hope to see many of you there. Otherwise, enjoy your weekend, everybody. Hopefully it was a great trading week for you, and we'll talk to you here next week.